I'm Sovereign Man analyst and writer Joe Jarvis. Like this video, join the discussion in the comments, and please subscribe and hit that little notifications bell so that you'll be notified anytime new content comes out. At Sovereign Man, we're serious proponents of improving your financial literacy and learning from some of the brightest minds in the investment business. So today, we'd like to introduce you to the so-called Warren Buffett Indicator, a proven metric that can help you make better stock investment decisions. The stock market is not supposed to be a casino. Our founder, Simon Black, thinks of stock investments as owning a part of a business. And as we've written in these pages before, why would you invest in a company's stock if you wouldn't want to own the business in its totality? Stock prices tell you what the market thinks a business is worth and reflect supply and demand dynamics on the day. But these price movements don't tell you what you really need to know as an investor. There are far more important determinants to a business's long-term success, including whether it operates in a steady or growing industry, it has low or no debt and improving margins, it has a solid management who are incentivized not as managers but as owners. At the time of this recording, the stock markets are way overheated. There's no doubt about it. A good question to ask then is, by how much? There are many things beyond our control as investors, but the one thing that we have full control over is what price we're willing to pay for an asset relative to its fair value. Disconcertingly, investing in the stock market has become a lot like gambling. Markets have turned into a place for frenzied speculation. It's no longer about picking well-managed companies with high-quality assets. Nearly all stocks have been rising, even companies like Coca-Cola, while their businesses are shrinking and revenues are declining. And still, a large percentage of investors are blindly buying those stocks. Clearly, many investors, both individuals and financial institutions, are not taking a bottom-up, value-driven approach. These so-called investors are not rolling up their sleeves and putting in the work and hours to do due diligence. They're not scouring disclosures like annual 10K filings. They're not running financial models to consider future cash flow. Consequently, a lot of retail investors especially are buying stocks without having a quantitative sense of whether what they're buying is well priced or not. But if you examine the relevant metrics, stock valuations are already severely stretched in 2021. The following two indicators can help give you an understanding of if you're overpaying, and if so, by how much. Two financial indicators that can help bring back sanity to stock investment decisions. The total market capitalization of US stocks divided by the US gross domestic product is one of several useful indicators for quantifying the extent of this overvaluation. Market capitalization, or market cap for short, is a company's net worth. So total US market capitalization is the combined value of American publicly traded companies. And GDP is an aggregate measure of consumer, investment, and government spending, plus net exports, or the country's total economic output. Total market capitalization relative to GDP is known as the Buffett Indicator because of billionaire investor Warren Buffett's affinity for this ratio. When the ratio is lower, as in the early 90s and after the sharp downturn experienced in 2008, it indicates that stocks are in value territory. And when the ratio is high, like today, it reveals that stocks are overvalued. The Buffett Indicator's fairly valued range is between -20% and 20%. That is, when the aggregate value of stocks is one standard deviation above or below America's GDP. But we're nowhere near the fairly valued range today. As this chart indicates, the total market cap to GDP ratio is over 220%. Moreover, that's over 80% higher than the long-term trend line and even higher than the dot-com bubbles ratio in the early 2000s. And it's not just the total market capitalization to GDP that reveals this. Let's review the price-to-earnings ratio of the S&P 500, the 500 largest US companies by market capitalization. The price-to-earnings ratio reveals how much investors are willing to pay, i.e. the multiple, for every dollar of company earnings. By this metric, over the past 70 years, the stock market has only been more overvalued once, during the dot-com bubble. Such high valuations, both for the total market capitalization to GDP ratio and the S&P 500 price-to-earnings ratio, reveal the abandonment of sound traditional investing principles. Again, we don't know or pretend to know how much longer this can go on. Months? Probably. Years? Possibly. But But what we do know is this: bubbles end, and they end especially badly for investors who entered markets near the top. And when they do, it can potentially take decades to recover the losses. Japan's stock market is a prime example. In December 1989, Japanese investors were in a frenzy. The country's Nikkei index soared to an all-time high of 38,957. But then, fearing rising debt levels and coming inflation, Japan's central bank hiked interest rates. Less than 1 year later, the market's value was cut in half. Over the past few decades, Japanese policymakers attempted to reinflate stock prices. But it wasn't until February 2021 that the Nikkei index finally got back above 30,000. And that's still 30% below the all-time high. The lesson: if you had invested in the Nikkei index in 1989 at the market top, over 30 years later, you would still hold a losing trade. And the US stock market is not immune from this same pattern. The bottom line: building a robust plan B takes diversifying and thinking outside the box. While stock markets today are at all-time record highs, there are still myriad opportunities for investors willing to look outside of the mainstream. And the more you can diversify your holdings, the more you can ensure that you'll thrive no matter what happens next. We like to think of that as the ultimate insurance policy. Thanks for watching. Don't forget to like, comment, and subscribe. And check the links in the description below if you'd like to learn more about how to craft a plan B